All right, we're back. Welcome back to the Halftime Report. Starbucks hovering around its all-time high. Mizuho thinks the run's just getting started. The firm upgraded Starbucks to a buy today, $75, the price target. That's another 16% upside from here. It is our call of the day. Jimmy.
I really like Starbucks here, okay? This reminds me of Nike about a year and a half, 2 years ago. Remember, it had languished for 2 years on the presumption that a fall off in North America basketball shoe sales had somehow beaten up the brand permanently. Well, that was false. Obviously, it was false, and the stock has rallied hard since then. That's what Starbucks is doing now. In this spring, there were all these issues, all these things that tarnished the brand, the incident in Philadelphia, Howard Schultz stepping down, closing some stores. That was temporary, folks. The brand is spectacular. And on top of that, they've got scale. So I know there are people out there, Scott, who say the menu needs a refresh. Okay, fine. Refresh the menu. They'll refresh the menu. Reminds me of McDonald's a few years back when they came out with all-day breakfast. There are all sorts of levers for management to pull here. I really like Starbucks.
They love, does Mizuho, sorry, Doc, the digital initiatives that the company's been doing. Momentum appears to be forming sooner than we expected, they say. After 3 years of growing into its multiple, Starbucks deserves a fresh look.
Well, I like what they had to say in the note, and I agree with your points, Jim. The one that I worry about is what Mizuho says when they talk about getting leaner and meaner, Judge. Because leaner isn't what you're paying for when you're paying $4.50 or more, depending where you are in the country, for a latte or whatever it is. Leaner means that maybe they're skipping some steps and going the wrong direction. They need to keep that thing at a high level. That's why one of the reasons, Jim, that I pushed back about the bathroom usage and so forth.
Well, it's more like...
It's not a luxury experience if you go into the Starbucks and there's an issue.
I mean, leaner means, okay, they were, let's buy this, let's buy that, let's buy that, let's buy them over there. Now they're saying, okay, that led to a way too disjointed business. So maybe they're back, bringing their focus back to where it belongs.
Right, and I agree. And that's what Howard Schultz did when he came back to the company on his first departure, if you guys recall. He came back and said, look, we got to do it better. We got to do it right. They've got to walk in and smell the espresso and all the rest of that. If they do what you're talking about, Judge, and don't buy from all these different vendors and they keep a consistent product in there, that's a positive. I worry, though, that if they're talking leaner, maybe they're cutting back on things, and that would be a negative for
Kevin,
a luxury brand.
Sorry, Doc, you own the name, Kev.
Yeah. My concern was, like Jobs leaving Apple decades ago, when you take that iconic leader in Schultz and he exits stage left, does the stock suffer? And I was concerned. But right out of the gate, new management's really been hitting it, moving the narrative away from China, which I think is great, and talking about domestic performance.
Well, that's where the turnaround really needs to...
And that's where it is occurring.
On
the other hand,
growth.
I'm trying to protect capital, so I'm almost 33% consumer goods and consumer services. So this index name with a 2-point and change dividend deserves to be in my portfolio. So I kind of held my nose and put a full weighting on it, and I've been rewarded because he's just talking about domestic performance and domestic metrics and getting growth back stateside and not just China. And look, it's working on the stock.